So the question is, how low is the market going to go? No longer is the market going lower? The market is going lower. The question has to turn to now, how low will it go? And we have two places where the market's going to want to go to check out that price. And I'm going to make sure we talk about that. I also want to talk about how time is actually your enemy and not market fall. So we're going to go over that. And then I have a few great charts that I've picked up off the Twitter sphere that is really telling in what is going on today. So stick around, we'll cover those and so much more. Hey everybody, this is RC Peck with Fearless Wealth, and this is my weekly video. Now, there are 3 reasons you want to watch the whole video. Number 1, if you've got money in the market, then I'm going to start to talk about it. I'm going to show you exactly where the market wants to go. And I have pretty high confidence it wants to go here to see if that's the bottom. So regardless of your age, you're going to want to see how much more the market can fall. Number 2, we really have to understand what the Fed is up against and what market we're in. We're taught that there's only something called a bear market or a bull market. Well, those aren't that useful because we're in a very specific type of drawdown, correction, crash, one that I don't hear anyone talking about, and we have to talk about that. And lastly, how do you just protect yourself, whether we are 6 months left to go or 18 months more left to go? Talk about how to protect yourselves. Okay, so let's get into this. First, what I want to do is I want to pull up a couple charts from other people and talk about them. Then I'm going to get over to the actual price charts. Okay, so this is from Willie. He's a CMT and a CFA. What I want to point out on here, let me get my cursor over here on the screen. What I wanted to point out here is this is the first time in 40 years. This is pretty interesting, where this correction has surpassed the previous correction. This is what happens when the bull market in bonds ends, and it ended 2 years ago. What I mean by that is the yield today on the 2-year. What do we have here? What is this? No, it's actually the 10-year. The yield today on the 10-year is higher than what it was before, see how this right here has surpassed its previous peak? It's now moving above that. It has changed directions. The 40-year bull market in bonds ended 2 years ago. This is yet another piece of evidence that is proving that, which I've been talking about for some time. Okay, here is probably the scariest chart of the year. The year is still not 6 months old. Now, what you're looking at, this blue line is the percentage loss in global bonds, the Bloomberg Global Aggregate Index. All those gray lines are all the previous years of what the market looked like. There's about 28,000 plus bonds on here. This market value is about $61 trillion. This thing is massive. The bond market is twice as big as the stock market. Here's the biggest thing that we really have to understand here. There's no plan. There's no plan when the bond market does this. There's no like, well, the last time it did this, when Tony was here, no one on Wall Street has experienced this. There's no playbook to this. And this is what's going on now. This is what happens with markets of instability. And we are in a market of instability, and it started at the beginning of the decade. This is what happens. Things that have never happened before are now happening. Now we're still talking about bonds here. The global aggregate bond market is down 16%. The problem is advisors sold to all of their clients that bonds go up when stocks go down, that bonds are safe when stocks aren't. That is not happening, and that has not been going on for 2 years. This is a market of instability. It's also showing us how much stress is on the market. And I'm going to get to price charts in 2 more, I would say slides, but 2 more slides. This is a tweet from Bespoke, and it basically shows wealth destruction. It's because the stock market's down. The stock market, depending on where you are in the world, is down 20 to 35%, maybe 25 to 35%. That happens. This is the combination of the stock market and the bond market. This is what is so different about this market drawdown, market correction, market crash. It is not just a stock market crash. And it is really affecting a lot of people because now their stocks are down 20, 30, 40%, and their bonds are down 10, 15, 20%. It's true wealth destruction like we did not see in the global financial crisis or the dot-com, because now two major asset classes, maybe collapsing is too big. I think for bonds, collapsing is a fair thing. This is what happens when a bull market in bond ends. But you have the two big asset classes in really, really bad shape and weakening. And that's what it looks like. So the wealth destruction has just been absolutely impressive. Now, also, too, there's more wealth today than there was in 2008 or 2000. But I think you get the point. The entire bond market is down. We can maybe call that crashed, and the stock market is accelerating to the downside. We talk about what to do and what's going on. I want to finish with this before we get over to the price charts. Now, this is a price chart of natural gas. It's just a one-day price chart of natural gas. The white line is what happened to natural gas in the US. Natural gas prices fell. There was a Freeport natural gas something that broke. Basically, a company's natural gas mechanism broke. It doesn't matter. The point is that in the US, that helped. It actually lowered the price. In the Netherlands or in Europe, it skyrocketed the price. This goes to really what's going on in the geopolitical world today. If you have energy independence like the United States does, or like Russia does, or like Saudi Arabia does, you can get away with a lot. The US produces an incredible amount of energy on the planet. It's actually the biggest energy in total exporter on the planet, not the biggest oil exporter. I think we're number 3, but I mean in total energy. When you're energy, I won't say we're independent because the US still imports, but they are a net exporter. This is what happens. So we're living in very, very different worlds. You live in the US, you have a very different experience than if you're living in Europe, than if you're living in Asia. But what is the same is the markets are correcting. So what I want to do is I want to show you, this is a very long price chart of the S&P 500. It's 75 years. I just want to point out something to you on this chart. I want to point out a couple things to you on this chart. The last time we went into a 50 to 80% correction, it took, I have to look over here, it took 6 years to get back to break even, and it took price back. This is not dividends included, but it took prices back 5.5 years. Now, it looks like it took prices back 11 years, but that's because I'm just showing you the S&P index. But just hear me out, maybe do the chart for a second. In 2008, it destroyed, I have to look here, it destroyed 6 years of returns. So it took the price back 6 years. I know. And then it took 5.5 years to get back to break even. So if you look at the price chart, it destroyed the last 6 years of returns, and it took, this is pretty incredible. It took 5 years to make up that loss. So what I'm talking about is just, it's time. People are losing time. That's 5 years to get back to break even. It destroyed their last 6 years. You go back to the dot-com and you're going to hear similar numbers to the global financial crisis. When the dot-com fell 50%, it literally pushed back. It went all the way back 6 years. You literally lost 6 years of gains. And at bottom, to get back to break even, it took another 6 years. I hope this is making sense. What I'm really trying to show you is time destruction, not price, but time destruction, literally destroying. You can start measuring this in decades. Back here in 1974 on the screen, this is pretty incredible. It destroyed 10 years of returns when the S&P fell 50% in the middle of the 1970s. It took 10 years to make that back up. That's pretty amazing. I'm bringing this up because we are in one of those markets now where commodities are the only safe place to be. Bonds are out of the picture. Stocks are out of the picture. I'm pointing this out because I'm leading somewhere. We can have years destroyed from the returns of the market, and it can take years to make that back. Literally having lost years, starting to measure them in decades. So I want to just show you something here on the screen. And if you look on the screen here, I just want to show you this. This is a price chart that goes back to at least where the price is 1957. That's when the S&P 500 was invented or created. And each one of those sections is basically a decade. And the 70s is where you see that big red bar called commodities. That's when commodities beat everything. Geopolitically, the 70s were a very, very unstable period of time. Stocks did horrible, bonds did horrible. Then we had the 2000s where commodities were the thing to own. Stocks had two 50 to 80% corrections, call them crashes. They had two of them. The 70s only had one. We're in that phase now where commodities are the only thing leading. It is very likely we will have at least one 50 to 80% correction in the stock market. Bond market collectively won't fall 50 to 80%, but it will do its relative best to equally fall as bad. And it'll be worse because people who are in bonds are in their 50s, 60s, and 70s, and they can't handle both their bond market, their bond portfolio, and their stock portfolio crashing at the same time. So what I want you to hear is we're in this period of stock instability and bond instability and market instability and geopolitical instability and political instability. That's what's going on today. We had it in the 2000s and we had it in the 1970s. So if you want to know what's going to happen over the next 6 months to 6 years to 8 years, it's really the 2000s and the 1970s over again. Doesn't mean to lose money. Absolutely not. It just simply means there's going to be a lot of price volatility, almost price violence in the market. Okay. And we're seeing that. Let me go and just show you a couple things, and then I will put a bow on this. We're seeing this. Utilities was a safe place to be. Utilities just over the last, actually, I can just go over the last few days. I'm recording this close of market on Thursday. Just over the last few days, this week, utilities are down 13%. And they're actually now negative for the year. They're down, I have to squint now because I'm not putting my glasses on, 9% down. This was a sector that was actually up 8% for the year. Now it's down 9% for the year. This is what it looks like with market instability, market unstableness. Here is called the S&P low volatility. This is code for where old people put their money if it has to be in the stock market. I'm going to lose a lot of people not liking that. Basically, it's anyone over the age of 50 or 60 or 70 where they put their money, their equity money. Now, in the COVID crash, it fell very, very hard. It fell 36%. The NASDAQ only fell 28%. Now you have this S&P low volatility ETF selling off this week. Again, this is close of market Thursday. It's down, let's round it, 10% over the last 4 days. And it's high to right now. It barely got positive for the year, but now it's down almost 16% for the year. This is what instability looks like. It moves around the market and is taking money from people. This is not a market to say, I've got to be in something. I got to be in something. I know people rushed into the Altria group because it had an 8% dividend yield. They're like, well, at least I'm getting a dividend yield. That person's asking themselves the wrong question. This isn't about where you find the best yield. This is about how you protect yourself. Now, we're 6 months into this. Global financial crisis went from peak to trough over 18 months. The 1970 fall, which was also in a commodity period where commodities were the asset class to be in, that was an 18-month fall from peak to trough. And then you have 2000, which, yes, was also in a decade when commodities were the lead asset class, and that was 30 months from peak to trough. So we're in a period where it's a year and a half to 2.5 years where it can take from the top to the bottom. Now, I don't know how it's going to be this time, but we have this period where the Fed has to increase rates into a falling market. They haven't had to do that before. They usually increase rates into a rising market. They're increasing rates into a falling market. If we look at the S&P, With dividends reinvested for the year, the S&P right now is down 23%, and they're increasing their rates. They're speeding up the rates, and the market's already down 23%. Now, I said that we want to know where the market could go. And right after this, I'm going to wrap this up. So here's the thing. The S&P is going to want to go to the pre-COVID high. If that's the case, and I believe it's absolutely baked in, that means the S&P has at least another 10 to, let's call it 10 to 15% to fall. From peak to where I'm talking, that means the S&P is going to bottom somewhere between 32 to 35%. So I think that's best case scenario, where the total fall for the S&P is somewhere between 32 and 35%. Now, if it does not stabilize there, we're looking at the S&P falling 50, and I'll show you right here on the screen. Expect the S&P to fall about 55%. Now, that will only erase 2 years. Just like I talked about in the 08 crash or the 2000 crash or the 1974 crash, they erased 5.5, 6 years, 10 years of performance. So even if we get down to the COVID low this year, that's only erasing 2.5, maybe 3 years, where the other big corrections erased 6 and 10 years. So it's still a serious correction, of course, but I just want you to kind of understand the market. It kind of baked in that the S&P is going to fall in total 32 to 35%. Find a bottom. If it doesn't find a bottom, it will do a full 55% correction. Okay, so the question is what to do. So we have the Fed speeding up the amount they're increasing rates. We have the bond market doing something it's never done in 40 years. The bond bull market is over. It ended. And what's happening right now are people are internally calibrating, wait a second, what's going on? My advisor said my bond portion was safe. That 40, 50% of my market was safe. Our portfolio is safe. It's not safe. It's actually creating more pain because there's no safety. And what I hear people saying is, I got to get in a part of the market that's doing better. That's the wrong statement to make. It's not like who can be in the worst performing part of the equity market. The question is, should you even be in the market? Those are the questions that have to be asking. And of course, just like the 2000s and just like the 1970s, the only thing that is working is, drumroll, commodities. And that's it. Thanks, guys, for being in my world. I appreciate the comments you leave. Leave a comment. Let me know what you're thinking. Let me know where I got it right, where I got it wrong. And if you like this video, you will definitely like the other videos we have on here. And I have over 450 videos and have been posting videos on YouTube for probably 15 years before it was a thing. And just ask yourself, if you're curious about how it might look to have someone managing your money that does not believe you should always be in the market, which I don't. I have stepped my clients out of the market. I believe that it is okay to be in cash for periods of time where the market is absolutely unstable. So if you've been questioning your advisor and you're on your second or third advisor and you really wonder why you have those 50, 60, 70, 80 positions that are all falling in unison, and you want truly something different, then go ahead in the description, click that. You can get on our calendar and talk to us about how it would be a different experience for you, one that has simplicity, clarity, followableness, understandableness, transferableness. Thanks for being in my world. I appreciate you, and I'll see you on the next video. Okay, bye.